Matt the Mortgage Guy here, coming at you today with a video on how to pay off your mortgage in less than 9 years without using a HELOC. So before I get into it, if you like good, honest mortgage advice, finance advice, please consider subscribing to the channel. I think that I do it in a way that's really straightforward, easy to understand, and I try to shoot straight with people. Knowing what I know about mortgages, how they work, finance in general, I'm trying to do what I can to bring good, honest information out there. So smash the like button. It helps this whole YouTube algorithm. More people get to see it. More people provide me feedback. Hey, it's great. It helped me out. I'm 5 states away, but I appreciate the content you're putting out. I appreciate reading that stuff. It's really makes me feel good, so I keep making these videos. So without further ado, how to pay off your mortgage in less than 9 years without using a HELOC. Now, this is not meant to talk smack to some of the stuff out there, but really some of the stuff I see that gets millions of views is just not realistic. Now, I'm gonna be nice. That's as nice as I can be. You can find 1,000 videos that talks about acceleration banking and using your HELOC, and they promote it as some magic potion that using a HELOC, you throw it at your mortgage, then you use it as a checking account, and all your money goes into the HELOC, and then you pay your bills out of it, and a certain amount goes down on the HELOC balance, and then you rinse and you repeat, and you throw $10,000 at your mortgage, and voila, your mortgage gets paid off in 5.5 years. While in a perfect world, I understand the math behind it, and it can work, the problem I have with it is that, one, it's not necessarily something that everybody has access to as far as qualifying for a HELOC, and two, if people don't execute it in the exact way that's meant to be executed, and it's got no real bumpers on it, there's the ability to spend more and increase the equity line more than it started out as, it's dangerous is what I'm saying. And so rather than that way, that in my opinion is risky, not very easy to do, not everybody has access to it, I'm going to talk about a simple way. Now, instead of all this fancy HELOC stuff where you throw it $10,000 at the mortgage, and then you throw your $5,000 in earnings in, and then you've got $3,000 in expenses, and then you've got throw your $5,000 earnings in the next month, and $3,000 in expenses. And I mean, these videos, I watch them, and I can follow, and I can understand with a finance degree. For the average person, I would imagine they're watching that video going, what in the world are they talking about? I've got an easier way. You got a $300,000 mortgage. Now, everybody's different, but what this plan, accelerated banking plan, banks on, and I've watched a few of these videos recently just to have something to talk about. What they bank on is that no matter what your income number is, let's call it $5,000 a month, you've got $3,000 in bills, and so there's $2,000 left over. And that's what that infinity banking stuff is doing. It's not creating money out of thin air. It's just saying you put $5,000 paycheck in, you spend $3,000, you're $2,000 net positive on pay down of that. There's no difference. Debate me on this, please. There's no difference in doing that and just saying, okay, I made $5,000, I've got $3,000 in bills. Hey, mortgage company, here's $2,000 in a principal payment every month. There's absolutely no difference. This thing actually has some lanes on it, some bumper cars. You can't charge $3,500, $4,400, $5,200 onto this home equity line when you've got $3,000 in bills. I'm sorry, take that back. You can, when you've got a home equity line, have $3,000, do extra stuff, and not pay the $2,000 towards the mortgage. If you're doing it this way, just saying, listen, I'm gonna stick to a budget. $3,000 in bills, $2,000 towards the principal. Every single month. Now, granted, this isn't for everybody. Trust me, this is for a small percentage of people. They're like, hey, I want to get aggressive. I want to pay my mortgage off. It's important to me. It's the most important thing to me. There's not other high interest debt that I have to pay off. This is the most important to me. This $2,000 month after month after month has this $300,000 30-year fixed 3.25%. I just typed in random numbers. 3.25% sounds like a lot, 2020 terms, but it might be average for somebody's mortgage right now. If that's your mortgage at a $300,000 balance, if you paid $2,000 a month for principal, you would pay off, what was it? 8 years, 9 months. Going off memory here, but that was it. It said it saves you 21 years and 3 months off of your loan if you pay $2,000 towards principal. Now, if this sounds ludicrous to you and you're like, Matt, paying $2,000 a month is ludicrous. Well, it's not any more ludicrous than this fancy HELOC plan where they're like, take your $10,000 HELOC, throw your $5,000 income into it, spend 3 of it on bills. So this is 5 in income, 3 on bills, down to 5, up to 8. This is 8K, and that's month 1. And then down 5,000 the next month you get paid, and then up 3, and now you owe 6, then you owe 4, boom, boom, and then when it gets down to 0, you take another 10,000 out and apply it towards principal. This only works if you're spending 2,000 less than you're making. And this number works for whatever you want to do. If you make 12,000, you spend 10, it's the same thing. And it works for any loan amount too. The math just comes out different how soon you get paid off. But this, what I'm showing here, this fancy accelerated banking system, the banks don't want you to know about this. I'm telling you it's the same freaking thing. Except in this scenario where you go, oh shoot, oh shoot, oh shoot, oh shoot, and you charge up to 9,000 because you had extra stuff come up, it throws your whole equation off. Similarly, if you pay 2,000 every month towards principal, you're like, listen, sticking to my budget, whether that's 3,000 or 8,000, it doesn't matter. And I'm paying 2,000 towards principal, 2,000 towards principal. This is gonna gain you the same thing. You're gonna be paid off in 8 years and 9 months. You're not gonna be at risk of going off the rails. Now, I'll be honest with you, what you will be at risk as if you got a little bit more play with that home equity line of credit, where if you've got stuff that needs to be paid, you just spend on the home equity line of credit. Once you send the $2,000 to the mortgage company, you pay down principal, it's kind of hard to get it back. The funny thing about it is, now that I think about it, you might want to go get a HELOC. If you've paid 2,000, you're like, holy crap, I didn't realize I had this expense over here and I got to do a $12,000 roof. Where am I going to get that money? You might want to go get a HELOC. But the moral of the story is, for most people, you know, this infinity banking, accelerated banking, whatever the heck they call it, it's, in my opinion, more smoke and mirrors than it is the big secret that the banks don't want you to know, and now you're going to magically pay off your loan in 5 to 7 years. But I'm telling you, there's some people that are just loving the Kool-Aid. They're on my Facebook feed. Oh, check out accelerated banking. They're all over the interwebs just talking about this big secret. I mean, there's people that have YouTube channels freaking dedicated to this stuff. It's all they talk about. And I don't know, maybe I'm a dummy that doesn't understand it. Maybe I'm just too slow, and my finance degree was at a college that wasn't up to par back in the 90s. I don't know. But I'm of the opinion that there's a simpler way to do it, and the way that I describe, where we just pay extra towards principal every month, is something that's a lot more easy to understand and easier to do for some folks that, their credit score or whatever reason, they just can't go get a home equity line of credit and do it that way, and they really don't want the flexibility that comes with the home equity line of credit, because flexibility means risk. That's it, Matt the Mortgage Guy. Any questions at all, please feel free to reach out, matt@mattthemortgageguy.com. Shoot me an email. Me or someone on my team will make sure we get back to you. I appreciate you watching, and until next time.